PSLF.
Awesome. Thank you. I'll go ahead and share my screen. And let me do a slideshow. Well, thank you guys for having me today. And we're going to talk about student loan repayment and specifically more so around the PSLF bubble and a lot of the PSLF updates. So we're going to go through quite a bit today, and also just general general student loan planning terms. But slow me down if anybody has any questions. Feel welcome to throw them in the chat or the Q&A section. I think that looks like it's open. And also forgive me, I have horrible allergies today. It kicks in. I'm in Georgia, so we get a lot of that pollen in Atlanta, Georgia, and I'm feeling it today. So working through it. But I really look forward to this conversation. Quick backstory. So I'm a consultant with Student Loan Planner. I was Georgia's first CSLP or certified student loan professional. And so far I've advised on over 460 million in student debt for over about 2,500 clients. And that's ticking up year after year. So student loans are my jam. And that's good news for those who don't want to deal with student loans, because I can help you navigate how to tackle them and how to think about them and how to be as efficient as possible with your student loan plan. And that way you could save as much money as possible and focus on other things. So let's jump into it. I wanted to touch on a couple terms. I think they're important to know or to visualize like what I'll be talking about here when it comes to the loans. So public service loan forgiveness in particular requires you to have federal direct loans. And there's a couple different loan types or words that you could see in your loan file. One is subsidized loans. So you might see direct subsidized loan. This is something that you could have borrowed in your undergrad education. They do not issue them for graduate school or post undergrad schooling. But they are loans that do not accrue interest while you're in the in-school deferment or in other periods of deferment. They're based on financial need. So not everyone in undergrad can access them. There's a limit on how much you can have, and it's based on financial need overall. But nicer loans because of that interest accrual benefit there. And then we have unsubsidized loans, which you can borrow for undergrad and graduate school. Undergrad, there's a much lower limit on how much you can borrow. Graduate school, though, you can borrow up to $20,500. And unsubsidized just means that the interest is not discounted in any way. So interest does accrue from when you borrow, but balance up to $20,500. So that might not be enough for the schooling that you're doing with your graduate school degree. So that's where you can spill over into those graduate plus loans. And they may have the word direct in front of them. All of these will, but direct graduate plus loans, you can borrow up to the cost of attendance minus what you're already borrowing from unsubsidized loans. So those are some terms that I thought I would just lay out there. Those are things that you'll see when you look at your loan file. So I want you to have a good idea of why you might have certain loans and why you might have so many too, because a lot of times folks will have two, unsubsidized loans and graduate plus loans, 2 loans each semester. And so when they graduate, you'll have a laundry list of loans that you're paying back. And you're wondering, how did this happen? Well, it's because they issue them by semester. But this is a little bit of background to give you some ideas here. Now, I figured what could be good for us to chat about is what is in the news lately. There's a lot of stuff student loan related in the news lately. So figured we could kind of go down the line on what's going on, what could be applicable to folks, what's just kind of noise, and then we'll go into some more PSLF specific details. But biggest thing kind of as of late, it's died down a little bit, but biggest thing that was in the news recently was loan cancellation. Up to 20,000 of loans could be canceled depending on your income. So there were income limitations, and everybody got really excited about it. There was an application that came out that you could submit. People got emails saying that they were approved. if it was going to be passed. So the problem with this cancellation announcement was that it was challenged. At the end of the day, it was challenged, and now it's held up in the Supreme Court. So it is in the court system right now. They're trying to decide if it's lawful for Biden to be able to cancel a specific amount of debt for just anyone, under those income thresholds, but, for the vast majority of folks. And so far, the case is not looking awesome. So that's, it was unfortunate because people got so excited about this cancellation, and it could have been really helpful for a lot of people. What's kind of interesting though for PSLF folks is unless your balance was closer to that 10 or 20,000 amount that they were planning on canceling, it's not going to be super applicable to you because your goal going towards PSLF is to pay as little as possible towards the loans. And you're going to be on an income driven plan, which we'll talk about those details here in a moment. So the payment is not determined based on the balance at all. So if your balance is $20,000 less because of this cancellation, let's say it does come through, it actually has no impact on your path towards PSLF. It doesn't make it cheaper for you. It doesn't shorten the timeline towards forgiveness. So really at the end of the day for PSLF folks, this isn't super impactful unless it was just going to pay off the loans now. But a lot of times that's not really applicable. Student loan balances aren't as low these days. So that's a little bit of the status of the cancellation. The income limitations were if you were single, you had to have made less than $125,000 of adjusted gross income on either 2020 or 2021's taxes. So they weren't even considering 2022. And you can get up for single people 125. For married people, it was up to 250,000 of income. And you could get 10,000 of loan cancellation if you're under those limits. You can get up to 20,000 though if you had received a Pell Grant when you went to school, which is usually issued in undergrad. And a Pell Grant was not a loan, but it was something that would have made the cost of attendance less for you. So that might give you an idea of if you were even eligible. Don't panic if you didn't submit an application. If it is approved, you can still apply in the future. But we're thinking and we're trying to guard our heart and tell folks that it may not come through. But if you're pursuing PSLF, at the end of the day, it may not have been helpful at all. So that might be good to know for y'all. Now, the next thing that's just actively going on is we have 0% interest right now still on federal loans, and payments are extended to who knows when. And what I mean by that is their guidance right now says that they're going to start payments back up 60 days after the Supreme Court's decision on this cancellation. And we still don't have a decision. And it doesn't seem like we're going to have a decision quickly. And more so, when I say decision, I mean that they were going to approve the cancellation. So that again is not looking great. Now, what they did say is that they'll do that as far as June 30th. And then 60 days after that is when they'll kick payments back in if there's no resolution in the Supreme Court. So that would put you at August 30th when payments would kick back in. It is possible that could get postponed again. I know they keep saying this is the final extension, it's the final one, and it might be. Don't take this comment as something that might definitely happen. It may not get postponed again, but it's a possibility. So far, all the servicers are gearing up for August for people to be entering repayment, August or September. So I think at the very least, just be prepared for that timeline coming up in August or September of this year. So that's the latest on the 0% payment freeze and due to COVID that started in March of 2020. So 3 years ago now, guys, we've had 3 years of 0% interest and no payments. And also, just a quick note with PSLF, all of this time during the COVID forbearance does count towards PSLF as long as you're working full time at an eligible employer with eligible loans. So that's exciting that, we're getting a lot of free credit right now, which we'll take as much as they'll give you. So next on the kind of what's been in the news is this IDR waiver. Or sorry, actually, that's at the end. I'll get to that here in a moment. But the new IDR plan. Sorry, got ahead of myself. So they're talking about originally they were talking about a new income driven plan, and then they kind of walked that back and said, maybe we just kind of revise one of the existing repayment plans. And so they did submit a formal proposal for a revision to the revised pay as you earn plan, or repay. And this has not been formalized yet or finalized in any way. But we do feel optimistic about this plan coming through. We think this could really be an opportunity or an option for folks coming up. So the new repay, what does that look like? So the new repay, if it's implemented, it would make payments a little bit less than the existing income-driven plans that we have today. For a couple different reasons. I'll touch on that when we get to the income-driven plans. That way we're just in that same headspace there. But in general, it'll make the payments a little bit cheaper. It'll also have a 100% interest subsidy, which is a really big deal. Not necessarily for PSLF folks again, but for people who go towards longer term forgiveness, generally people who go towards longer term forgiveness, because it means that the balance won't grow. So if your payment based on the income driven plan is less than what the interest charges per month, on the regular repay plan, that would mean that your balance is growing. Your interest is accruing on the balance. So your balance is growing over time. Now, repay already has a subsidy. 50% of that unpaid interest is waived. But this new plan that they're proposing would be 100% of that unpaid interest is waived. So you could really be making interest only payments and your balance would never increase or grow. So I think that's a big benefit for a number of different reasons. It makes your effective interest rate less if you look at it that way mathematically. So those are some two big adjustments. And then it's also going to allow folks to exclude spousal income, which has been the big hang up on repay just since it's been out, is that currently it requires you to include your spouse's income to the payment equation. This new repay plan would allow for filing taxes married separately to keep the payments off of just your income. So that's also a very big deal as well. So we'll talk a little bit more about this as we get into the income driven plan information. This, again, has not been approved yet. We're thinking it could be something either finalized this year and maybe people can enroll by the end of the year, or maybe next year, to be determined though. Now, the PSLF waiver and the IDR waiver. The PSLF waiver has expired. That expired as of October 31st. However, there are some sneaky ways we can also take advantage of some of the benefits of the PSLF waiver. So we'll talk about that here coming up as well. The IDR waiver, that's kind of where I'm talking about there being a sneaky way to still get access to the PSLF waiver, but we'll get into those details here in a bit. So those are the most recent kind of bigger things in the news about student loans. Let's get into talking about PSLF first and foremost, and then starting to talk about some repayment strategies. Now, again, feel welcome to throw any questions or comments in the Q&A. Happy to slow down and answer any questions as we go. All right, so PSLF. Public service loan forgiveness. There are technically 5 requirements that we have to check the box off for to be eligible for this program. And this is not a repayment plan, but it's a program that you can pursue with your federal student loans that will forgive them after about 10 years of qualifying employment. More technically 120 payments, but we'll get down there. So the 5 requirements, first is we have to work for a qualifying employer. So that's any nonprofit, 501c3, or government entity. So that could be federal, state, local, tribal, city. This has to be government in some form or fashion. And then we have to be working full-time for this employer. So that's the second requirement. Now, full-time originally, and this is still active right now, but it's going to be changing slightly here coming up in July. But full-time means that we have to be working what the employer considers as full-time, that many hours per week. So if the employer considers full-time 40 hours a week, you have to be working 40 hours a week. If they say full-time is 25 hours a week, the minimum is 30 hours a week. So that's not going to fly by PSLF's definition. Now, if that sounded confusing, it is because there was kind of two different definitions. So they're standardizing that full-time definition here coming up in July, where you just have to work 30 hours a week total on average at your qualifying employer or employers. So if you're at two different eligible employers as a W-2 employee, you can be eligible for PSLF as long as the hours reach up to 30 hours a week on average. So now the third requirement is we have to have direct loans. And we talked about the different types of loans you might see on your loan file. Direct loans just mean we have to have those federal direct loans. Now, if you have anything in your loan file that says FFEL, like the capital letters FFEL, you need to take action. You need to convert those into direct loans. You can do that by a process called consolidation. FFEL loans do not and will not ever be eligible for PSLF. So you have to fix them. They can if you convert them into the direct loans, but not as they are. They can't be eligible as they are. Now, fourth is we have to be on an income-driven plan. And when I say income-driven or IDR, that's what I'm saying here. IDR just stands for income-driven repayment plan. There's technically 4 right now. There could be there could be 5 coming up, but we have to be on one of the income-driven plans, and we want to be on the cheapest one. Whatever's the cheapest that will get you to the finish line with the least amount of money spent. So we'll talk about those plans here in a moment. And then we have to have 120 qualifying payments. So that's 10 years if you were completely consecutive with your work history and with your payment history. The COVID forbearance counts, these months of forbearance count without you having to pay. So that's nice because it's kind of 3 years and a month of free credit so far. And we have to check all 4 boxes above for a payment to qualify. That's key. All 4 boxes have to be checked. So work at an eligible employer, be full-time, have the direct loans, be on an income-driven plan, and make 120 payments. So it can't be any shorter than 10 years. There's no shortcuts, unfortunately. But I'll pause. I think there's something in the chat. Let's see. Does previous employment count towards PSLF, or do you have to be employed at a qualifying employer after graduation? So you have to have the loans outstanding and you have to be eligible to be in repayment. So if you're working at an eligible employer in school, but you're not making payments on your loans, that's not going to count. And technically you can't be in repayment if your loans are in the in-school deferment. So that's a trick there. Not trick, but that's just something to be aware of, because I know a lot of people do internships and they think that that might count. And it could if you've graduated and if you've started to enter repayment, or if you're in the COVID forbearance now. But the months or the years that you're in school and the loans are in the in-school deferment, they cannot count. Let's see. And not sure I understand that question in the Q&A. So if you could elaborate on that, I could circle back to it. All right. So we talked about PSLF. Let's talk a little bit about the PSLF waiver. Now I mentioned that this expired, but there are some ways that we could still kind of take advantage of it in some ways. So I'll explain that. Now we talked about the eligibility requirements. Let me go back to that page real quick. We have to check all of these boxes. If we weren't checking one of these boxes in the past, so let me maybe preface this by saying if you're a recent graduate and you just started entering repayment, or you just got your loans on track for PSLF, the PSLF waiver is not really applicable to you at all. This is just applicable to people who may have had prior payment history that was deemed ineligible for some reason. There might be a second chance at going back and getting credit for those prior months. So new folks who recently have entered repayment or are in the COVID forbearance, this is not for you. But let's say you previously had FFEL loans or Perkins loans. Perkins loans are issued by the school, but they can be consolidated into direct loans and they can be eligible for PSLF. So let's say you had some of those older loans, the FFEL or the Perkins, they weren't eligible for PSLF. Well, you can consolidate them to make them eligible, and you were supposed to do that by October 31st. But we can still do that because of the IDR waiver, which we're going to talk about here next. So it's not too late if you didn't do that already. We think you could still get credit. And let's say maybe in the past you weren't on an income-driven plan. Maybe you were on one of the standard plans that just weren't eligible for PSLF, and you had ineligible payments because of that. The PSLF waiver, it would have counted those prior months. Now, same thing, if we submit documentation that you were employed by that eligible employer during that time, then we think you could still get credit, even if it's after this October 31st deadline. The key is that you have to still be employed at an eligible employer, which I would assume most, if not everybody on this call, is still employed at an eligible employer. So if there's anything that you need to go back and claim credit for that maybe you missed in the past, or you have to fix something, you could still do it because of this IDR waiver that I'm going to talk about next. And the action items would just be, we have to consolidate those FFEL or the Perkins loans into direct loans, and or we have to submit an employment certification form for all eligible employment since October 1st, 2007. If you're not sure if an employment time period would count, it doesn't hurt just to submit for it. Worst they can do is say that it's not going to count. But make sure you submit all eligible employment certification forms. Okay, I'm going to pause real quick. Let's see. Oh, if you were in school, you mentioned we get 3 years credit due to COVID. So no, if you were in school during the COVID forbearance, again, you can't get credit. It would just be if you were actively working at an eligible employer and your loans were eligible to be in repayment. So if you're in school full-time, usually they automatically put your loans into the in-school deferment, which automatically makes you ineligible for PSLF. You have to be graduated, in repayment status, or in the COVID forbearance status, not the in-school deferment status. So that's not free unless you were already graduated, if that makes sense. How do you know if your employer is eligible? So there is a handy dandy tool on studentaid.gov. It is the PSLF help tool. So you would go to studentaid.gov, sign in, or not. You don't even have to sign in to check this, but you would go to loan forgiveness. There's a loan forgiveness tab. You can go to PSLF, and there is a PSLF help tool where it can help you search for eligible employers. Now you need to have the employer's EIN number, which stands for Employer Identification Number. This you can find on your W-2. It's around tax time. We should have that already. And if you just started, maybe you didn't get a W-2 for last year because you weren't employed last year, then you can ask HR for the EIN number. But that's crucial to have. You need that EIN number. Then you could plug that in, and it'll tell you if it's in the system as already being eligible. It'll also tell you right off the bat if it's not. So that'll quickly, give you your decision there on if you should complete the form. And rarely, but it does happen, you'll get something that says likely ineligible or undetermined. And what that means is no one has ever submitted a form for that employer before. And so it's up to you to submit that form so that they can review it to make sure that they are eligible. Doesn't mean that they're not going to be eligible. It just means that no one's ever submitted a form for them before. So go ahead and submit it. They'll check the eligibility. So that's on studentaid.gov, I think /PSLF. That's how you can get to it maybe faster. And then would this process be submitted to our loan provider? So technically, no. The employment certification form, the help tool, when you go through and you input your employer information, this is actually brand new information. We learned this 2 days ago. So y'all are some of the first folks to maybe hear about it. They used to make you print out this form, take it to work, get a physical signature, and you'd have to mail it back to the servicer called MOHELA. That's MOHELA. MOHELA is who's deemed responsible for this PSLF program. If you're not at MOHELA already, that's okay. When you submit the employment certification form, they would pull your loans over to MOHELA. And the reason being is they just want everybody who's in PSLF to be under one roof. So it's easier for managing, because the Department of Ed, these are federally held loans, remember that, but the federal government is not managing them. They're outsourcing that to a contractor, and they want one contractor to be responsible for PSLF. So with that said, you would mail, or you used to have to mail it, sorry. If you complete this now, it gives you the option to electronically send a signature link to your employer. This is huge because it used to be so time consuming, I would say, and kind of clunky to have to print the form, take it to work, get a signature, upload it to the portal, or put it in the mail if you didn't already have MOHELA. So this is a huge improvement. It's going to cut down on time. So what you would need is just to have the email address for who is able to sign off on the form. And what they're signing off on is just confirming that, yep, you do work there. You work there full time. That's all they're doing. They're not confirming how much you make. They're not confirming anything else but the fact that you're working at that employer. So they're going to get a signature link now, as long as you have their email that you could send it to. And then that's how you submit documentation. And then, so it all technically goes through studentaid.gov or MOHELA, where those forms are eventually processed. But those are some good questions so far. Okay. Now we talked about the PSLF waiver, how you could kind of still get credit. I say kind of, but you can get credit for it still. You just have to still be at an eligible employer. Let's talk about this one-time IDR payment adjustment. And again, this is relevant to people who have had loans and who have been in repayment in the past or have been in forbearance in the past, not those that just graduated. Now, those that just I know I'm talking a lot about things for folks who have had loans for a while, but if y'all are in the bucket of you just graduated, you're just trying to get your ducks in a row, you're doing a great job so far. I'm, commending you for coming to this information session to learn about this program. This is how you prevent problems, and you check all these boxes from the beginning, and you make sure that there's no surprises later. That way you don't have to rely on these waivers or these, these second chance offers. So we will definitely continue to talk about implementation and how to get going with these things here in a moment. So don't feel like I'm leaving you guys out. Thank you guys for being here and listening in if you're new. So the one-time IDR payment adjustment, or we're calling it the IDR waiver. I think it's been called that multiple times by different people. What is this? Well, this is how I think the Department of Ed is sneaking in the ability to still do the PSLF waiver as long as people still work at an eligible employer, because what the one-time adjustment is doing is it's allowing people that have those incorrect loan types to still consolidate. And they originally said you had to consolidate those FFEL loans or the Perkins loans by May 1st of this year. But recently they changed the website to say end of year. But then they changed it back to May 1st of 2023. And we panicked for a second, but then they changed it back to end of the year. So that's just to say that we're not sure exactly when you have to have this consolidation done, but it is still before May 1st. You have time. If you're in that boat of having the wrong loans and you need to take action, you have time to do that before May 1st. You might have more time because it's probably to the end of the year at this point. So that's where you could fix your loans and still have those prior months on the loans count towards the PSLF timeline. So you wouldn't be starting from zero if you're consolidating. And this is relevant to folks who don't think that they're going to end up finishing out PSLF. Let's say, you may be leaving public sector in the future, or you could potentially see yourself, doing something different in the future, whatever the situation. There is still loan forgiveness with the income-driven plans. It's just not as short of a time frame. It would be either 20 or 25 years. So if you have those older FFEL loans or Perkins loans, you could consolidate them and have all of those prior years count towards the 20 or 25-year timeline. And if you're close, if you're at 20 or 25 years, you could be eligible for forgiveness now. Now, that may not be anybody on this call, but I thought I would mention that just in case. If maybe your parents have had loans around for a long time, if that's the case, have them look at this as soon as possible. Now, similar to the PSLF waiver, it's going to count, any non-IDR payments that were made in the past. So you didn't have to be on an income-driven plan in the past to have those months count towards forgiveness. Now you have to be on one going forward after this COVID forbearance, but these two waiver opportunities have been significantly helpful and beneficial to people who just didn't have the right information from the beginning, maybe, who had some misconceptions about these programs. Now is the time that, it's a second chance at getting it right and kind of bringing you back to whole on, if you missed out on credit in the past, now you can go back and get that credit. So that's what the IDR waiver is all about. Let me know if there's any questions there. Now, I figured we could get into a couple general topics on how to treat or think about your student loans. We'll talk about the income-driven repayment options in a moment as well. Now, thinking about your federal student loans, PSLF is a little tricky because it's a short time window. So this rule of thumb may not exactly line up with your situation. So bear with me. I'll kind of explain what I mean here. But if you're someone who has federal student loans and your balance is less than your income, then long-term forgiveness, the 20 or 25 years, probably is not going to make sense. You want to treat the loans like a debt and pay it off if you're not going to be doing public service loan forgiveness. Public service loan forgiveness is kind of a game changer because it's such a short window of time compared to the 20 or 25 years. It's half of that time frame or less. So it could make sense if your balance is less than your income to still entertain public service loan forgiveness. It really just comes down to the math on what the payment is going to be. And does that mean you pay off the loans before you get to the 120 payments or not? Is there still a balance that's left over? So there are some free calculators on studentaid.gov that you could use to see what your income-driven payment would be. There's also free calculators on our website, studentloanplanner.com, that I think are very robust and very helpful in helping you distinguish which repayment plan you could use or should use. So check out our website too for the free calculators we have. But PSLF, it starts to come down to the math on if it's going to make sense. Does your income-driven payment end up just paying the balance off before you get to 120 payments, or not? And is it worth entertaining? Do you like the thought of being in public service longer term? So those are some of the things that we talk about on our consultations too. Just, what is the reality of, what does PSLF look like? What does that mean? What are the pros and cons? Now, if your balance is a lot greater than your income, then I think PSLF is definitely going to make sense as long as you stay in public service. Mathematically, you will have a forgiven balance. And I put in here that we would treat the debt like a tax, if that's the case, if your balance is a lot greater than income. But really, in general, if you're going towards PSLF, we want to be treating the loans like a tax. And what do I mean by that? Because we are actually in tax season. So this might resonate with you guys a little. It'll be fresher, I think. But you don't want to pay more tax than you have to, right? You want that tax refund to be as high as possible. So use that same mentality with the student loans when going towards PSLF. You want to pay as little as possible towards those loans. And we want to maximize how much we can get forgiven later. So there's no reason to be paying extra on the balance or the interest or throwing lump sums at the loans if you're trying to go towards loan forgiveness. It's just, that's a waste of money because that's not getting you to loan forgiveness faster. So you just want to pay what's required, the monthly payment each month on time in full, and that'll get you to PSLF very efficiently. And we need to be using one of these income driven plans that I've been mentioning. So there are 4 right now. We have income contingent repayment, which is one of the oldest out there. It's based on 20% of discretionary income. And I'll just tell you right now, you probably don't want to go on this plan because it's the most expensive. It doesn't make sense. We want to pay as little as possible to maximize how much we can get forgiven with PSLF. So IBR may not make sense either. There are certain scenarios where it could. I'll mention that here in a moment. Pay as you earn and repay are probably what the majority of you are going to be looking at. They're both based on 10% of discretionary income. And the difference between the two, repay has that interest subsidy we were talking about. So an interest discount doesn't quite matter for PSLF folks because that doesn't mean your payment's less. It just means that your balance isn't growing as much. But the downside to repay is that it requires you to include spousal income. So if you're married or if you're married in the future, no matter how you file taxes, they're going to ask for your spouse's income, and that's going to be calculated in your payment. So that's sometimes not a great thing if you're trying to keep the payment as low as possible, especially if you went into that relationship with the expectation that these were your loans, you're taking them over. So that's where pay becomes very attractive. It doesn't have the same interest subsidies. Again, it doesn't quite matter for PSLF folks, but it's the same 10% of discretionary income, and it allows you to exclude spousal income if you file taxes married separately. So that's where tax filing status starts to come into play when we're talking about income-driven repayment and student loans. If you've ever wondered why like taxes are important when it comes to student loan planning, this is why. If you're married, you have to consider if you're going to be filing taxes jointly or separately. Student loans could be a reason to be looking at filing taxes separately. And so pay keeps that payment off of your own income. Now, let's say you don't have access to pay, because if you borrowed before October of 2007, you are not eligible for pay as you earn. So then you're left with repay, IBR, and ICR. What if you're married? Then we don't want repay if we're trying to exclude spousal income. So the next best option is IBR, income-based repayment, at 15%. So it's 15%, it's higher, but it's 15% of just your income instead of 10% of the household income. So that's sometimes the strategy we have to kind of figure out is, which repayment plan is best for your specific situation based on what you're eligible for, what your marital status situation is. Does your spouse have student loans or not? So it can get kind of confusing. It's not a simple answer as far as like which plan, everyone should be on repay or everyone should be on pay. I can't really say that because it depends on a lot of different factors, but generally we want to be on the cheapest one for your specific situation. Okay, so one question I have is, do you think the income limits will increase yearly? So the percentage that your payment is based off of, the 10%, the 15%, that's not going to increase. That's in the promissory note. It cannot increase on you, but your income can increase. So you might have those small pay raises and promotions year over year. So that does mean that your payment's going to increase because you have to update your income every year. So your payment will grow, but it's because your income is growing, not because the repayment plan is growing. Let's see. Okay. Thought I saw one other. Oh, yeah. What is discretionary income? Are you allowed to subtract cost of rent and other necessities? That's a great question. And good catch. Good catch. Sometimes folks don't realize I say discretionary income. Now, discretionary income, that is a calculation that the Department of Ed does to kind of account for expenses that you might have, your necessary expenses. What they do is they take 150% of the poverty line, which that would be about 20,000 as a household size of one. So if you're single, they take 20,000 and they subtract that from your adjusted gross income. So your payment is not based off of gross income. It's based off of this calculation, the adjusted gross income minus 150% of the poverty line, which is about 20,000 for a single person. It goes up by 5,000 every family member that you have. So if you're married, it's about 25,000 they subtract. If you have a couple kids, that goes up to 30 or 35,000. So the larger the family size, the larger the deduction. And that's how they calculate the payment. So they take that, you get your discretionary income, and then the 10% is based off of that discretionary income number. There are calculators to do this on studentaid.gov and our website. So don't feel like you have to, to do that number crunch. There are calculators out there that can do that for you if you're curious about, what it would be. But that's a good question. All right. Well, we've got about 13 minutes left. I'll just quickly go through some common mistakes that I see when it comes to student loan repayment, and then we could reserve the rest of the time for questions or reviewing anything that was unclear. So the first mistake I see all the time, unfortunately, and fortunately, it's not really for folks going towards PSLF, but I do want to throw this out there in case you have, if you're in this situation about to graduate, or if you have friends who are graduating, or kids in the future that are graduating. So refinancing is a term where you take the loans out of the federal system to a private company. So it's privatizing the loans. If you refinance your student loans, and a way you can maybe think about this in regards to something you might have experienced, you probably get mail from SoFi or Laurel Road or Discover or like banks telling you, hey, reduce your interest rate on your student loans. And it will have this really attractive interest rate, like 3 or 4%. That sounds great. And that goes towards like traditional debt advice, where you're told to just get the interest rate as low as possible, pay your debt down as fast as you can. Refinancing, though, is a permanent decision. If you go and you refinance your loans, you take them out of the federal system, they will not ever be eligible for PSLF again. So it is a catastrophic decision if it wasn't the right decision for you. So you have to really look at the pros and cons of refinancing. Everyone on this call could be eligible for PSLF. So we would not want to be entertaining refinancing. If you're in a position where maybe you pay off your loans before you get to 120 payments, like based on your income driven payment, maybe refinancing makes sense at that point. So I'll kind of talk out of both sides of my mouth right here, where I'll say, there are certain scenarios where refinancing does make sense. So if you're someone who would end up just paying the loans off before you hit 120 payments, because your income driven payment would be so much to just pay the balance off, refinancing could be a good idea then, because then you could reduce the interest rate, pay it back still pretty aggressively like you would be with the income driven payment, but maybe with lower interest. So that's the first just cautionary tale. Don't refinance if you're planning on doing PSLF, but maybe consider it if you're going to end up paying the loans off before you get there, or if you might see yourself going into private sector in the future. Now, second big mistake that I see, is avoiding ownership because of fear of your loans or just avoiding your loans altogether. Maybe, you haven't thought about the loans since COVID shut off payments. This is the first introduction to thinking about your loans again. Well, I will say thank you again for being here and for starting to learn about these options and putting yourself out of that putting yourself into that uncomfortable zone of talking about student loans, because these are not fun topics. Debt is not a fun topic. And unfortunately, student loans are sometimes the first introduction that you have to personal finance. So that could kind of scare you, especially when it's a very large balance you're looking at. It's maybe a large payment, the first payment that you saw, maybe it's large compared to what you can afford within your budget. Maybe the terms of PSLF just feel really overwhelming. Don't feel alone when you're feeling that way. It is a very overwhelming situation to be in with student loan debt. We are in a place where it is the norm almost to have student loans and to have significant student loan debt. So there's also shame in that too. So there's a lot of just negative feelings around student loans. So I understand how avoiding your loan situation can be the easier route. But I will say, I think this is a great step, this conversation we're having today, to take ownership of your loan situation, to start getting some ideas on how to tackle your loans. Oftentimes, when I have meetings with folks, when I talk to folks about their student loans and we talk about their plan, the plan itself is a lot less scary than the unknown, or than that what people thought the plan was going to be. So I love that, because I love and hate it. I love that, they feel confident in the plan. They feel good about it. It's way better than they thought it was going to be. But I hate that they felt so scared of it for so long. They could have had that peace of mind a lot earlier. So don't avoid your situation. You could be wasting time. You could be wasting money if you're not on track. You could be wasting peace of mind. And that's an important thing to mention too, is it's not just the money, it's also the mental stress that this might have on folks. So don't avoid your loan situation. If you need help, there are options out there. There's free help on studentaid.gov. You can communicate with your loan servicer, or you can hire a professional like Student Loan Planner, where we do this day in and day out, and we help folks navigate their loan situation. So, but thank you for being here today. This is a great step. Now, third mistake I see is just not having perfect information about the forgiveness options. So we talked, I think, quite a bit about the technicalities of PSLF. I hope you feel more confident about it, but make sure you're checking those boxes. Make sure you feel confident that you're on track for PSLF. That way there's no surprises later on in the future. So, just make sure you're checking all the boxes. You can communicate with your loan servicer about making sure you're on track, or again, with a professional. There's lots of free content on studentaid.gov and Student Loan Planner's website about how to qualify, how to maintain eligibility, how to reduce your payments, things like that. So just make sure you have the right information and you stay on track over time. And we talked about those income-driven plans. We talked about PSLF. Now, using the wrong repayment plan. So that's another mistake that I see is folks get on maybe IBR, income-based repayment, because they think that's what they need to be on for PSLF, but they're eligible for repay or pay, and that's based on 10%, so it's cheaper. So pay attention to that, as there's 4 different income-driven plans. It's not just one, and we want to go on the cheapest one. So, with ICR, that's the most expensive income-driven plan. We don't want to go on that. We want to be on one of the cheaper ones. The extended repayment plan, the standard repayment plan, the graduated repayment plan, those are all what's called amortized options, which they take your balance, they spread payments out for a specific period of time, and you pay off those loans within that period of time. None of those plans are eligible for for PSLF. They're not income-driven plans. So we don't want to be on one of those plans long-term. We want to be on an income-driven plan to be eligible for PSLF, thus eligible for forgiveness. And then lastly, we need to be using, one of these two strategies. So the biggest mistake I see is someone falling somewhere in between these two strategies. We want to be either super passive, which, remember the tax example. For PSLF, we want to pay as little as possible towards those loans to maximize the forgiveness. So we're going to be super passive towards our loan situation. Or if we're not going to end up doing PSLF long-term for whatever reason, mathematically or just job-wise, then we need to be more aggressive and just pay the loans off, or consider the longer-term forgiveness if that makes sense. So those are the main mistakes I see, some of the bigger mistakes that I see time and time again. So start to think about your plan. I know payments have been paused for a long time. There's been every excuse to not think about your student loan situation, but get yourself going in the right direction. We do have a calculator on our website that you could download that helps you calculate these plans. It also has the potential new repay plan, which that new repayment plan, we are optimistic about it. I just get nervous talking about it because I don't know if all these terms are going to change. So what they're thinking about doing for the repay plan is they want to make the poverty line deduction a lot more. So we talked about how that discretionary income is calculated. It's 15% of discretionary, 150% of the poverty line deduction. They want to increase that to 225% of the poverty line deduction. So that would make just about anybody's payment cheaper. But they also want to make undergraduate loans based on 5%, not 10%. And if you have kind of a weighted, like you have some graduate loans, some undergraduate loans, you'd have the undergraduate loans charged at 5%, the graduate loans charged at 10%. So the plan overall could be a lot cheaper per month. And like I mentioned at the very beginning, it could allow you to exclude spousal income. Okay. So those are some big things that could come about with the new repay. We just don't know if any of them are going to stick. So to be determined on what that's going to look like, but it could be a good option. We just want to know more about it before, getting excited about it. I like to guard everybody's hearts. So I will pause on the resources page and I'll take a peek at questions. Okay. Can starting your own nonprofit qualify? Being self-employed for the working component of PSLF? So technically, yes, you could start your own nonprofit. It just has to be a legitimate 501c3 entity. And you have to be working full-time or 30 hours a week for that full-time, for that eligible 501c3. So you can do it. I've seen people legitimately do it. You have to have a board of directors. You definitely want to hire a CPA and a business attorney to make sure it's all done right and you maintain eligibility year over year. That's sometimes the hardest part, is maintaining the 501c3 status. So you'd want to have those professionals in place to make sure that you're doing it right. Let's see. Can you exceed a full work week of 40 hours? Let's say you work for an employer for 40 hours a week that does not qualify for PSLF, but then you are self-employed for a nonprofit and work an additional 30 hours to meet the requirement. Is that allowed? So yes, as long as you're honestly working the 30 hours a week in the nonprofit on average, that could in theory work. That sounds like a very busy schedule though. So that's up to you. If you find a new job with an employer that's also PSLF eligible, how quickly must you update your employer information with the loan servicer? I recommend doing it soon just so you make sure that the new employer is eligible. But there's not really a requirement for when you have to update them. The employment certification form is submitted at kind of your leisure. We recommend submitting it once a year to make sure that they're counting up your payments correctly every year. But you don't have to do it once a year, but I do tend to recommend doing it every time you leave an employer. So you capture all of that employment history. And when you start a new employer, so they have the new employer in the system. So that's just what I would suggest. For those of us who are about to graduate and start making first payments on student loans, aside from enrolling in an IDR plan, what else do we need to do to be on track for PSLF? So definitely enroll in an IDR plan. It could be advisable to consolidate right after graduation. That waives your 6-month grace period. That's kind of required. It is required. After graduating, you have a 6-month period where you're not required to make payments. It's kind of like a grace period before you start your job. Those months, though, can't count towards PSLF. So if you're immediately employed in public service, you'd want to consolidate to forego that 6-month grace period and get into repayment sooner. That way you could start getting the payments to count sooner. So that's what I would suggest, is maybe consolidate right after school and then submit an employment certification form to get going. All right. Is it worth consolidating your loans if you decide it makes more financial sense to pay your loans off directly than going for PSLF? Is it worth, I'm thinking you're meaning, is it worth refinancing your loans? So it's worth it if you can get a lower interest rate than what you already have. If you can't get a lower interest rate, then no. When you're talking about privatizing your loans and just paying them off instead of doing PSLF, the name of the game is trying to pay as little as possible on interest. And so if you could get a lower interest rate, then yes, it could make sense there.
So do you have to consolidate before you refinance?
No, you don't.
Okay, so
You
if you're
can
refinancing, you don't need to worry about consolidation at all.
Yep,
Okay.
if that's the plan. And let's see. And yes, there are calculators that determine which makes more sense to go for PSLF or to go and refinance. You could put in your salary numbers. So the calculator that we have on our website is pretty robust. You can put in your income numbers for different years and get a feel for what that would look like over time, and if mathematically it's starting to look like PSLF does make sense or not. Once you start paying loans, is the money you earn that goes towards paying the loans still included as part of your AGI on your tax return? Yes. Payments made to student loans are not deductible, unfortunately, but you do get a interest deduction, maybe up to $2,500. You can deduct of interest paid from your student loans if you're below certain income thresholds. Shakes out to be about $500 worth of savings on your tax return. Otherwise, they are not deductible any other way. How do you know which IDR plan you are eligible for? Is it only based on current income? So the payment is only based on current income, yes. So anybody who has federal direct loans is eligible for repay, is eligible for ICR, the 20% plan. If you borrowed after 2007, then you'll be eligible for pay as you earn. IBR, you can be eligible for if you have FFEL or direct loans. So that's a little more flexible, but so generally you'll be eligible for most plans, maybe not pay though if you borrowed before 2007. Okay, got that one. And then can your salary be too high where PSLF does not make sense or there is little benefit? So yes, it can be too high where the payment itself is high enough to just pay the balance off before you get to loan forgiveness. So that's where those calculators come into play. You could use the free calculators on studentaid.gov or on Student Loan Planner, our website. We have free calculators as well. Or you could work with a planner, in person to navigate your specific situation. So awesome. I think we got to all the questions, and it is just a couple minutes over time, but I will pause in case there's any
Awesome.
more.
Thank you, Megan,
Yeah.
again for doing this for us. I definitely learned a little bit. I hope everyone else on the line did as well. I guess the last question I have for you, if you're comfortable, do you mind maybe dropping your email in the chat? So if there are any other questions that come up, people might be able to reach out to you.
Yeah, here, give me 1 second and I will do that for you guys. I actually have a discount link as well. If anyone would like to schedule a consultation with me, it'd be $100 off our normal consultation price for just attending this webinar today. So let me find that and I'll drop that in there as well. Let's see. Yeah, thank you guys for having me tonight, and I'm thankful I didn't have a sneeze attack while we were here. Or I'll just put my email in. It's just megan@studentloanplanner.com. So if you have to go, just copy that down and I'm going to find that link real quick. Okay, I think I found it. And this is the link for just one-on-one consultations. If you are interested in having one-on-one help with your situation, it's just $100 off that normal consultation price. And that's the link you can use. So awesome. But thank you guys for having me. And I hope you were able to take a nugget of information. Email me if you have questions, schedule a call with us if you'd like some more specialized help. And yeah, I'll let you guys in the night.
Awesome. Thank you, Megan.